Welcome back. Today's explainer tackles day 2 of our crypto trader journey, and it's all about demystifying the essential mechanics of a crypto trade. If you've ever stared at a trading screen that's just packed with flashing numbers, complex charts, and bizarre terminology and felt completely overwhelmed by it all, well, you are in the exact right place. We're going to strip away all that jargon, break down the actual tools you need, and build your foundational understanding completely from the ground up. By the end of our time together today, I promise those intimidating screens are going to start making total sense.
Here's our roadmap for a single trade today. We are going to cover 1. Where to trade, exchanges. 2. Spot and futures trading. 3. Mechanics, pairs and order books. 4. Execution, types of orders. 5. Costs, fees and slippage. And finally, 6. Practical, paper trading workflow. It's a logical, highly actionable sequence.
Section 1. Where to trade, exchanges. Because obviously, before you can make a trade, you've got to choose your arena. Let's look at the very first decision every single crypto trader has to make, which is choosing their trading environment.
Now, this actually highlights a fundamental philosophical difference. On one hand, you have a CEX, or centralized exchange. This is a lot like a traditional stockbroker or a bank. It gives you a highly structured, regulated environment, you get customer support, and, crucially, easy account recovery. But, and this is a big but, you have to trust them to hold your funds. On the other hand, a DEX, or decentralized exchange, represents the core peer-to-peer philosophy of crypto. You maintain complete self-custody of your assets, meaning you trade directly from your own wallet using smart contracts. No middlemen whatsoever. So the question you really have to ask yourself right off the bat is, which environment best suits your specific needs for security, control, and convenience?
Section 2. Spot and futures trading. Okay, once you've chosen your exchange, you have to decide what kind of instrument you actually want to trade. Let's compare the two primary methods here. Spot trading is incredibly intuitive. It's exactly like buying an apple at the grocery store. You pay the current spot price and you take immediate possession of the actual asset. If you buy Bitcoin on the spot market, you now hold that physical, digital Bitcoin in your account. Futures, however, are an entirely different beast. With futures, you aren't actually buying the asset itself. You're entering into a contract. You're effectively betting on where the price of that asset is headed in the future. So spot is all about ownership, while futures are about pure price speculation. And surprisingly enough, futures actually count for the vast majority of all crypto trading volume today. And if you spend, any time at all in crypto, you're definitely going to hear the word perps, short for perpetuals. Crypto actually innovated the perpetual contract. These have absolutely no expiration date. That means you can hold a leveraged position indefinitely, provided you have enough margin in your account to keep the trade open. It is a wildly powerful tool, for sure, but it's also one that requires a very deep respect for market volatility. Section 3, mechanics, pairs and order books. So, we know where we're trading, and we know what we're trading. Now it's time to put on our mechanics overalls, get under the hood, and look at the actual engine driving the exchange. First off, assets aren't just traded in a vacuum. They're traded in pairs. Think of a pair kind of like a fraction. The first currency listed is your base asset. The second one is your quote asset. So if you look at the pair BTC/USDT, Bitcoin is the base and Tether is the quote. And here's the real aha moment for understanding this. The base asset is always priced in terms of the quote asset. You are either using the quote asset to buy the base asset, or you're selling the base asset to receive the quote asset. Truly getting your head around this dynamic is step 1 to reading any trading screen correctly. So where do all those buy and sell intentions for those pairs actually go? Straight into the order book. The order book is the absolute beating heart of the exchange. It's a live, transparent ledger that shows exactly where buyers are willing to buy, those are the bids, and exactly where sellers are willing to sell, the asks. When a buyer's price and a seller's price finally meet, boom, a trade executes and the price of the asset officially moves. It is pure, raw, real-time supply and demand visualized right there in front of your eyes. Section 4, execution, types of orders. But how do you actually interact with that order book? Well, you need controls. You need your steering wheel and your brakes to navigate this fast-paced market. Basically, you have 3 main levers you can pull as a trader. First up is the market order. When you use this, you are telling the exchange, get me into this trade right now at whatever the best available price is. It prioritizes maximum execution speed, but it offers literally 0 price guarantee. Second is the limit order. This is you saying, okay, I will only buy at this specific price or better. This one prioritizes strict price control, but the catch is you might not get your order filled at all if the market never reaches your exact price. Finally, the stop order. Think of this as your safety brake. It stays hidden until the market hits a specific trigger price that you set. Once it hits that trigger, it activates, usually to protect you from further losses or maybe to catch a breakout.
Section 5. Costs, fees, and slippage. Now, we're going to do a slight shift in tone here just to offer a word of caution. Trading isn't free, and the market certainly isn't frictionless. We really need to talk about the realities of execution costs.
This brings us to a hidden cost that catches so many new traders completely off guard: slippage. Imagine you hit buy on a market order when Bitcoin is sitting at exactly $50,000. But the market is moving so incredibly fast that by the time your order reaches the exchange, maybe just milliseconds later, the price has jumped to $50,050. That $50 difference? That is slippage. It's the gap between your expected price and your actual execution price. And honestly, it's just the inevitable tax you pay for market volatility. So whenever you formulate a trading strategy, you absolutely have to calculate the total market friction. It's really a combination of three things. First, exchange fees, the little percentage the platform takes just for facilitating the trade. Second, if you are using a DEX, you have network costs, often called gas fees. These pay to process the transaction on the blockchain. And as we all know, on a bad day, those can sometimes cost more than the trade itself. And third, the slippage impact we just talked about. A smart trader knows that a trade must not only look profitable on the chart, but it has to be profitable enough to cover all three of these frictions before it ever puts a dime in your pocket.
Wow, okay, we've covered a tremendous amount of ground. Exchanges, spot versus futures, pairs, order books, order types, and fees. That is a lot to digest. And naturally, it leads to this exact question. How on earth are you supposed to master this complex workflow, dial in your execution, and account for all this friction without risking your hard-earned money while you're still learning?
Section 6. Practical paper trading workflow. Let's see how this all builds into our final actionable resolution today, building a risk-free environment. So this right here is your homework. It's called paper trading, and here is your 4-step workflow. Step 1, choose a platform that offers simulated trading. Lots of major exchanges or charting platforms offer this totally for free. Step 2, open your paper trading account, which will magically be loaded with fake simulated funds. Step 3, start pulling those levers. Execute simulated market orders, set limit orders, and practice placing your stop losses. Step 4, keep a journal. Seriously, track your trades and rigorously calculate your hypothetical fees and your slippage. The key here is to treat this fake money with the exact same discipline you would treat your real portfolio. And that brings us to the end of day 2. You now understand the fundamental mechanics of the crypto exchange environment. You know how the engine works, you know how to use the steering wheel, and you definitely know how to spot the hidden tolls on the road. The screen is no longer just a bunch of flashing lights, it's a logical system. So the only thing left to ask is, now that you actually know the mechanics, are you ready to step into the simulator, test your strategies, and tame the chaos of the crypto market? Get out there, set up that paper trading account, and I will see you in our next explainer.